Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Well, before I start today's session, let me take a few seconds to pat myself on the back. Now, this pat on the back is because I had made a prediction a few months back in a piece that I wrote on the Equitymaster website. The link to the piece is given in the description box below. Anyways, the key takeaway from the piece was that from a risk-reward perspective, the share price of PVR INOX doesn't appear to be too favorable. Put differently, I had predicted that the share price of PVR INOX had a strong chance of going down than going up in the current calendar year, that is 2023. The piece went live on November 28, 2022. The stock was trading at a price of close to rupees 1900 per share. As I record this video, the stock is trading at a price of rupees 1400 per share. This means that the stock is down more than 25% in 6 months, which I believe is a considerable fall. So this pat was essentially for getting the prediction right, at least till now. Anyways, investing is a field where it is almost impossible to be right 10 times out of 10, which means I also have predictions which have not worked out well. But I try to be right at least 6 times out of 10, and I am happy to get this one right. Now, moving on to PVR INOX, what makes this fall even more noteworthy is that the broader stock market has been flat or has gone marginally higher during the same period. So it is not as if the entire market is down and hence PVR INOX is also down. The entire market has been holding up quite well. Therefore, the fall has to do with challenges facing the company or the company's own fundamentals than the broader market sentiment. So what are these challenges? And more importantly, has the risk-return equation turned favorable after the 25% fall from the top? Let's find out. Let us talk about the challenges or the business fundamentals first. What do you think are the different ways in which a stock can underperform? Well, if you ask me, there are 3 ways this can happen. A stock can underperform either because of exorbitant valuations, or consistent losses, or even high leverage for that matter. Think of it as a student who has to clear 3 subjects in order to be called a smart or an intelligent student. If he fails in any of these subjects, he will not be termed as smart. Likewise, a stock with poor marks or poor grades in any of these 3 parameters is a dangerous stock to own in my view. It can underperform perhaps in a big way and put your overall returns at risk. Now, what about a student who fails in all the 3 subjects? He'll certainly not have a good reputation, isn't it? Likewise, what about a stock that is trading at expensive valuations, is frequently loss-making, and also has a high amount of debt on the balance sheet? Should not one stay away from such stock at all costs? I certainly think so. You see, some time back, I ran a test to identify such stocks, and one of the names that popped up was the multiplex major PVR Limited. Yes, you heard that right. Back in November 22, when I wrote the piece, PVR Limited had a valuation problem, a debt problem, and also a profit problem. In other words, it was a student with poor marks in all the 3 subjects. Now let us understand in more detail by starting with valuations. I believe that it is difficult to make money on a consistent basis if you buy stocks with a P multiple of 40 times or more. You may get lucky with a few stocks, but to consistently pay high P multiples is a recipe for below par returns in my view. Is PVR currently trading at a PE of more than 40x? No. The stock is currently loss-making and has a negative PE ratio, which is not good either. It means that the company is struggling and has run into rough weather. Therefore, PVR can certainly be called a dangerous stock based on its negative PE ratio. In case you find this unfair, please note that the highest EPS or the earnings per share the company has recorded was in FY19. Even on this high EPS, the PE ratio back in November 22 stood at close to 50 times. Therefore, the stock was expensive based on its all-time high EPS as well. A high debt to equity ratio is another big red flag for me. Companies that load their balance sheets with more debt than they can handle are constantly flirting with danger. They find it difficult to tide through tough times. Now, based on FY22 numbers, PVR had more than rupees 5,000 crores of debt on its balance sheet against an equity of close to rupees 1,400 crores. This is certainly on the higher side and well above what I consider to be the danger mark of 1x. Now, upon closer inspection, rupees 3,700 crores out of the total debt of rupees 53,000 crores consisted of lease liabilities. Now, this cannot be termed as debt in the true sense of the term, but even if you exclude this, the debt is still higher than equity, albeit only marginally. Therefore, PVR still can't escape the tag of being dangerous based on the debt to equity ratio. The last parameter is about whether the stock under consideration is running a profitable operation in the present. Now, I am not interested in future promises of profitability. If the stock is loss-making currently or has recorded losses in a minimum of 2 years over the last 5 years, then it's a big red flag for me. PVR has recorded losses in both FY21 as well as FY22, therefore once again finding itself in the list of dangerous stocks, this time based on profitability. Of course, one can be lenient towards the stock as FY21 was a terrible year for the industry due to the coronavirus pandemic. However, a loss in FY22 as well as over the last 12 months does not augur well for the long-term fundamentals, which is why it does not make sense to give the company a clean chit on this parameter. So there we are, 3 parameters of valuation, debt and profitability, and PVR INOX Limited finding itself at the receiving end of all 3. Now, if the stock would have had 1 cross or even 2 crosses against its name, I wouldn't have labeled it dangerous. However, having 3 crosses, that is failing on 3 important parameters, is not a good sign. Such stocks should be stayed away from for at least a couple of years, if not more. By the way, did you notice that all my analysis is backward looking? I have not mentioned a single word about the stock's outlook and future earnings. Shouldn't this also be considered while deciding whether the stock is dangerous or not? Won't these factors count for something if the stock has a bright future ahead of itself? Well, the odds are stacked against the company, to be honest. I am of the view that it is difficult to get all the 3 parameters back on track over a short-term period of 2 to 3 years. Let's do some quick back-of-the-envelope calculation to drive home the point. PVR has now merged with another listed multiplex chain, INOX Limited. The two together will now lord over 50% market share in multiplexes, and the stock may become one of the rare monopoly stocks in India. However, size does not necessarily translate into higher profitability. Besides, the starting valuations also need to be considered, no matter how good the underlying stock quality. Our analysis suggests that PVR will dilute a little over 50% of its equity in order to take INOX into its fold. Now, considering PVR's and INOX's best profits, which they achieved in FY19, and PVR's current share price, the combined entity trades at more than 40 times even after the 25% fall in share price. this is still expensive in my view. The maximum P that one should pay for a stock like PVR Limited should not be more than 25 to 30 times, to be honest. Therefore, the stock is 30% to 40% more expensive based on my estimate of its fair value, and that too based on the best earnings of both the firms. Of course, it's a different matter if the growth over the next few years turns out to be stellar and the combined entity is able to extract synergies way beyond our expectations. However, investing in the stock based on such aggressive assumptions would be speculative in my opinion. Therefore, once the two entities merge, in fact, this has already happened, the stock may cease to be dangerous based on its debt to equity ratio and even profitability. However, the current expensive valuations could ensure that significant wealth creation in the medium term looks like a distinct possibility. In fact, I beg your pardon, does not look like a strong possibility. So, to cut a long story short, the upside from the current share price does not seem to be much, given how a lot of expectations seem to be already built into the share price. Therefore, caution needs to be exercised to that extent. Let me know what you think of my viewpoint. Also, please do not forget to like, share and subscribe in case you found the video useful. I'll see you again next time. Goodbye and happy investing.